The broadcast is now starting. All attendees are in listen-only mode.
Okay, so good morning and welcome to the webinar, 5 Secrets to Getting the Banks to Say Yes. In today's session, what we're going to be talking about is just really how to get finance for a small business owner. Living in a challenging times now where people actually do need to get that finance, and there's a lot of sort of uncertainty and unknown. So I've invited two people, Mark and Chris from FinancePath, to join in on our discussion today, just to really help us understand a bit more about how we can get the banks to say yes, and what are the tips and secrets that would help the business owner do that. So I'd like to welcome Mark and Chris to the call today. Welcome, guys.
Thanks, David.
Excellent. Do you want to just start by telling us a bit about your background?
Yeah. Okay. So FinancePath is a mortgage management business. We've been in business for 10 years now. We specialise in residential lending and also commercial and business lending. Our client base is quite diverse, from the first homeowner to the established and savvy business owner. So it's a big, I suppose, benefit and an interest as to why we're in business, because we get the benefit associated with the experiences of all those different types of clients.
Great. So let's sort of, and Chris, a bit of your background.
Yeah, sure. I've been in financial services for about 10 years now.
Yeah.
And joined FinancePath 3 years ago, initially as a client. So I'd experienced the other side of the fence with FinancePath.
Yep.
And then moved into to the FinancePath business 3 years ago and enjoying the time there.
Yeah, great. So really, I suppose, without further ado, let's maybe sort of talk about the main topic is how does a business owner get funding? How does a business owner go to the bank and say, I need some money, and the bank say yes?
Yeah, well, we termed this the webinar around the secrets to getting the banks to say yes. And I think before we even delve into those, one of the first things that we can't stress enough is understand your business. And what we mean by understand your business is understand, when it comes to funding, exactly what the banks want you to know about your business. And quite often that's a different thing than what we experienced business owners think that banks actually want them to know. And there's probably a few parallels in terms of the way that what banks want to know and what you really should want to know in a business. And David, you may agree from your coaching side of things that when you enter into a business, you should always be looking and keeping an eye on, or have a clear exit strategy, whatever that may be.
Yeah.
3 years, 5 years, 10 years. Know exactly why you're in business and how you want to exit out, if you want to exit out. And when you think about that from a lending perspective, the banks are exactly the same way. They're about to enter into a contract with you, which is a loan agreement. And at the end of the day, they want to know how you're going to and how they're going to exit out of it.
Yeah.
So they've always got an eye on the end in terms of, okay, well, what you bring to the table, and show us how you're going to exit out of that particular agreement. And when you can start to focus everything that you do when it comes to putting a business funding or proposal in place, that constantly ties back to how are we exiting out of this loan agreement, you're going to find that your proposals are going to have a lot more success than those that don't address that. Because,
Right.
I mean, the statistics out there from and they're varying statistics around the failure rates around small business, and anywhere between 1 and 2 and 1 and 3, by all accounts, can fail or will fail within the first sort of 5 years.
Yep.
Now, to what we see, or from what banks see, and the reason why bank funding is harder to get is because at the end of the day, people going into business fail to manage that cash flow side of things, and that's one of the big focuses from a bank's perspective.
Yeah, look, and I would agree with you. Often when I talk to business owners, we talk about business plans, and most people glaze over, or they've done one when they started. And I see that there's two kinds of business plans. It's like there's two kinds of books, right? We have the books that we use to get our tax return, which has all the adjustments in it, and then we have the raw numbers. Now, the problem with using the tax return to manage a business is it actually doesn't give us the raw numbers of what's actually going on. But similar situation, I suppose, with the bank is our business plan is about growth strategies and marketing and all those sort of nice things.
Yeah.
The bank doesn't care about that.
No.
What's their main focus on?
So really, at the end of the day, their focus is on two things, and two things that are basically at the end are the same, and that's their exit strategies. And the two exit strategies for banks are, firstly, how are you going to manage the repayments through the term loan? That's exit number one.
Right.
So if they've got a loan agreement in place and your repayments on that loan are $3,000 per month, your business plan needs to address in every possible manner how your existing or new business is going to manage those repayments.
Right.
That's their first exit out, that you'll see the loan term out through to completion. The other second exit that they're obviously looking for is, okay, well, let's just say that the business plan doesn't go to play. And the reality is
they're forced into some sort of sale to recoup their costs.
Right.
And that, at the end of the day, which most people, I dare say, listening to this will be familiar with, is where that security comes into it.
Right.
You know, whether it's your own home, etc. But security is normally their second out, their second exit.
Okay.
So a bit about what we'll probably cover off today is, you know, how do you avoid always using that second exit and the old home as security for your loan.
Yeah, because I suppose my traditional understanding is if I want to go to the bank to get money, the only thing they're really going to loan me money against is my house.
Yep, and that's understandable. And look, the reality of the situation is that's still first and foremost the way in which most people will fund their business, be it a startup or an established business, and that's okay. We'll cover off some of the pros and cons associated with that.
Yeah.
But as an extension of that is what you need to know as a business owner, and what we want to sort of cover off today is you need to reverse your psychology around how you actually go about obtaining funding.
Right.
And part of that is understanding what the marketplace is doing out there, what different lenders are doing, because different lenders will have different appetites at different times. So I don't know if those out there have seen or heard, but NAB have got a very big push out at the moment around, okay, hey, we hear and we understand Australian business. Now, is that actually the case or not? Well, that's up for debate.
Yeah.
The ANZ also jump onto their website and they're talking about at the moment that we pledge to lend $1 billion to small business over the next 12 months. Will they meet that pledge? Who keeps them accountable is a different case in point. But what you're starting to see is that banks are marketing to different niches, and you need to be aware of what niches they're after, because different banks have different appetites for different types of funding at different times.
Right. Okay. So really, part of getting the money from the bank is understanding what's the flavour of the month.
What sort of business are they interested in? Yeah, and it changes.
Okay.
It changes depending on what their mix of business is at any one point in time. No different from the listeners' businesses themselves. They want certain type of clients and they want to sell certain type of product, probably at different times because it's got different margins.
Right.
Banks are the same.
Okay, so really understanding your business and understanding the banks or the variety of the banks is really the starting point.
Yeah.
And from understanding your business, I suppose we're going to talk a bit more about this, but exactly what does the bank want to see?
Yeah, definitely. So we'll jump into those, we'll call them funding secrets. And the first one that we'd like to discuss, I suppose, and cover off is understanding or relationship. Relationship is out of these ones that we're going to cover off, and it sounds really obvious, but the reality is most people don't understand or don't take the time to create the right relationships with the right people.
Yeah.
You know, people will sit there. What we've seen is most people do their everyday banking or have their home loan or whatever it may be, some relationship with an existing organisation.
Yes.
And when they go into business, they will normally gravitate to the familiarity of that particular institution.
Right.
Now, that's all well and good, but the reality is if you want to obtain the best possible business funding, you need to take the onus on yourself to go and get out to the marketplace and start to interview the different lenders out there and understand exactly whether they are the right, whether they're the right organisation for you.
Yeah.
You know, you have to ask, the keys here is to ask the right questions of the right people. So once you've identified the different lenders out there that are going to provide you with the type of funding that you need or that you believe or you understand that you need, then you have to break it down to persons, because I dare say the listeners have also experienced a bank manager that moves every 2 to 3 months, and you can't create any consistency or continuity, I suppose, continuity, I should say, with a particular organisation. And the reality, CBA is not the CBA. The reality is it's David Guest working for the CBA. If you were working for the CBA and you moved across to the NAB, the reality is I am more likely than not going to be better placed to move with David Guest than I am to remain with the CBA.
Right.
No different from everyday business. It's about creating and forming the right relationships.
It is interesting because a lot of people see the bank like an enemy.
Yep.
That you sort of try and not tell them the whole truth, or you make up stories to try and get this money, where the reality is that if you have a relationship with a manager or someone who's stable within the branch, you can actually get an inside running.
And what you talk about there is stable is really important. So what I want to give the listeners, I suppose, here is understand the right questions to ask. And some of the right questions to ask is, and this is the reversing of the psychology, you're going in there and interviewing them as much as they are interviewing you.
Right.
It puts you in a position of control. Whether you get all the right answers or the answers that you want is really, in part, a little bit irrelevant. You're taking control of the situation. So the questions such as, you know, what sort of funding results have they been able to achieve for businesses like yours? Because different businesses have different needs, be it retail, manufacturing, etc. So what's their track record over the past, and make it give them a time period, the last 12 months, because in changing environments all the time. So you want what they have done to be recent and relevant.
Yep.
What level of authority do they have to approve the funding? Really important. Don't waste your time. It's like when you're trying to go and sell your own product and service. Don't spend all your time selling to somebody that can't make a decision.
Right.
When it comes to dealing with the right person within the bank, you want to make sure that they have the authority to be able to approve your funding. The other things is the positions that, and you mentioned before, stability. How long have they been with the bank? And how long have they been with that particular branch? You want to start to get a feel for whether they're going to be in it for the long haul with you. And do they handle the relationship past the actual funding being provided? Plenty of people at the end of the day, they provide the funding, and then once that happens, you hand it over to an account manager. And if you've got any issues or concerns moving forward, you don't have that continuity again of dealing with someone that understands the background. There's some key things that everybody should be asking of their existing business manager or one that they're looking to take on board.
It's a very different perspective because most people will go cap in hand to the bank and say, can I have money?
Yep.
What you're suggesting is we should be going in and actually determining whether we want to actually do business with them.
And we're not going to try and pretend that obtaining business funding is easy, but what I would say is switch that psychology, because at the end of the day, and you're seeing it at the moment, and why NAB and ANZ are pushing towards this business funding, is because they are in the business of the best money that they make is through lending.
Yeah.
Understand that they're in the business of lending, so they do want to lend, but in the business space, you got to tick a few more boxes than you do in others.
Yeah, and I suppose it's true. When the economy slows down, the bank is now screaming because no one's lending money, and that's where they make their money. So, so obviously their objectives are to build client base. And they actually get a bit aggressive. So they're actually becoming competitive. And starting to provide some sort of edge in that market. So really, what you're saying is make sure that you do build a relationship with someone who can actually help with those decisions. Fantastic. Okay, well, let's move on to the next topic, which is the security one.
The second funding secret is understanding that without doubt, security puts you, and putting up security puts you in a stronger position to obtain funding in the eyes of a lender.
Right.
Now, that doesn't always have to be your residential security.
Okay.
What you need to do is understand what security you have available to put up to the bank.
And just so we're clear, security means basically some sort of guarantee, some sort of asset
or guarantee that you're willing to put up that they can use.
Yep.
Now, in the eyes of the bank, that's simply risk minimization. It provides them their second exit should you fail to meet the repayments or the terms of the contract. Now, as I touched on before, residential security is not the only option you have.
Right.
And in some cases, separating your personal finances from your business finances is really important for a small business owner.
Yep.
So let's look at some of the other security options that you may have. And it's important to understand what you want and what you're prepared to put up before you go into a bank.
Sure.
Put yourself on the front foot.
Okay.
Another form is, one of the forms is your commercial property.
Yep.
But the benefit of that is actually does separate the personal from the business.
Right.
The commercial property is typically linked to the business anyway.
Yep.
It is deemed as suitable security for banks to lend against. They will lend sort of anywhere between 60 to 80% of the valuation.
Right.
And it can be tied to the bank. So there's some benefits associated with that.
Yep.
And provides them a strong exit. Commercial property is easily tradable. Turnaround times are quite simple.
Okay, so that's the obvious one. Is after the home, then comes the building that you if you own your own building.
Yep. Exactly right. Exactly right.
Fantastic.
Secondly, you can look at plant, stock, equipment, and you can fund against plant, stock, and equipment.
Right.
That provides some flexibility for you to be able to sort of fund some growth, be that through manufacturing equipment, forklifts, excavators, agricultural equipment, whatever that may be, whatever stock that may be that you hold. Benefit to that is that it provides you can get 100% of that funding against that asset.
Yep.
One of the cons associated with that is, however, they're typically depreciating assets, so the loan terms will be less, the interest payments will be higher.
Right.
But one of the pros associated with that, it gives you some certainty of payment and avoids you actually tying up valuable capital. And helps fund future growth, so you can manage your cash flow with some certainty going forward.
Right. So really looking at the balance sheet, we need to be looking at other things other than property and saying, well, is there any other assets here that the bank would recognise?
Absolutely.
Because obviously the less we take the big chunks of capital, the more we've got flexibility.
Absolutely. And understanding a bank that specialises in particular types of plant and equipment funding, there's definite specialist lenders out there that specialise in that.
Yeah.
And understanding where their specialty is, where their niche is, and where their appetite is at any point in time is really important to help you get that funding.
Yeah.
So as Mark touched on before, ask the questions, do the research.
Yeah, fantastic.
Debtor finance is another option you can look at. The increase in debtor finance has been profound over the last 4 to 5 years since the last global financial crisis, and that's effectively borrowing against the debtors or the invoices that you have on your book.
Right. So this is like factoring.
Yeah, the old term was factoring.
The
Yeah.
old term was factoring. So
Yeah,
basically, people owe us money.
Yes.
We know it's coming, but it's just not being paid yet.
Yep.
The bank looks at that as an asset.
Yep.
And says, yep, that's a security we're willing to back.
Absolutely.
Fantastic.
Now, not all banks will do that, and some banks will require quite substantial turnover and really good history and that sort of financing to lend against that. But it's another option to alleviate some of the cash flow issues that many small businesses or medium to longer term businesses have.
Yep. Fantastic.
And finally, another one that is underutilized, but more so utilized in business financing as opposed to personal finance, is third party guarantees.
Okay.
You have to have a good relationship with the person that you would be approaching for the third party guarantee. But effectively, what that does is they put up a security that the bank deems they can hold.
Okay.
In the event that you should either fail to meet the repayments.
Yeah.
That person would then be liable to make the repayments. In the event that they can't make the repayments, the security that they put up could be used as a second exit for the bank.
Right.
So once again, just minimising your risk in the eyes of the bank.
Right. So all they're looking for is there something we can grab?
Yes.
Should we have to go for option 2?
Yes.
And so if it's your mother-in-law's property, that's okay.
Yes, if you've got a good relationship with your mother-in-law.
Right.
If you have one now, you might not towards the end. And look, and we always need to stress in this particular space as well too.
Yeah.
Any third-party guarantee, it's a really, really important scenario to have your ducks in a row. The guarantors understand their obligations.
Yep.
Even though it's more prevalent in the business space, I think as Chris has said, as opposed to the residential space.
Yeah.
That it still it requires them to have you don't want to be taking on people, I suppose, that don't understand your business.
Right.
Because we see a lot of trouble where people have gone to that because it actually is a bit of an easy option.
Yeah.
Might be friends, relatives, etc. But the friends or relatives have always just done it as a favour as opposed to really understanding what they're getting into.
Mm-hmm.
And our experience is that causes more troubles than solutions.
Okay. So really the key here is that there's many other options other than just the home.
Yeah,
absolutely.
And really often people will overlook some of those other sort of hidden securities that are available, which could give them the option to get the cash flow.
Also puts you on the front foot in terms of negotiating or getting approval with the bank. If you can offer security and satisfactory security for the bank, you'll often achieve pricing advantages.
Okay.
You'll have less sort of covenants on the loan term and the repayment conditions.
So better rates as well.
Better rates, absolutely, in some cases. And you'll be less likely to have to sort of provide personal guarantees if you can offer suitable security. Doesn't actually have to be the house.
Yeah, fantastic. Okay, so that pretty much covers the security area. Let's talk about the next one, which is an interesting one, which is contribution.
Yeah, and when we're talking about contributions, probably separating between startups and established businesses is important here.
Yeah.
A lot of people on the line are possibly existing business owners. There might be a few that are looking to get into business, but regardless of the circumstance, you need to demonstrate. It's like with any business relationship. If you're going into a business relationship, i.e. a loan contract with a bank, they want to see that you'll come to the party with something else. If you're going to ask them to stump up $100,000, they want to know that you've been able to invest in that particular business idea or that business growth yourself. If you can't demonstrate that, then you're going to be pushing the proverbial uphill. So from a contribution perspective, a lot of people sit there and go, well, hang on a minute, I don't have any money, right? Because that's what I'm coming to you for. That's what I'm coming to the bank for.
Yeah.
So understand what contribution actually means in the eyes of a bank. So if you have, for argument's sake, a business idea, it's really important that through the infancy, and we're going through this as a business ourselves actually at the moment, in terms of being able to clearly demonstrate the amount of time, investment, money and research that's gone into getting that business idea up and running. So if you look at over the last 6 months, we've probably invested around about $50,000 in research and time into human resource as well as tangible other expenses. Yeah. And if and when we required bank funding, we'd be able to go and demonstrate that, hey, this is what we've already put up. We don't necessarily have $50,000 now in terms of free cash to put towards that idea. Hence, hey, Mr. Bank Manager, while we're coming to you. But this is where we've diverted other business profits into this business, into that particular business idea. Right. So understanding that concept of saying, hey, a contribution, you don't necessarily always have to come and say, hey, I've still got $100,000 that I'm going to throw into this. Yeah. The reality is I have and clearly been able to demonstrate that I've already invested into the opportunity.
Right. Okay.
Yeah, and that's important. It's important to know. You'd like to think that a business or bank manager would be able to lead you down that particular path and ask you the right questions to build that out. But hey, the reality is a lot of these bank managers do move from time to time. There's probably a bit of inexperience out there, and that comes to obviously interviewing and getting the right business manager.
And like you say, being on the front foot with that one, because I wouldn't ever consider a contribution as actually something the bank would be interested in.
Yeah. Well, they want, at the end of the day, they need to see that you've been able to manage or come to the party. It's like, say, if we put it to the person that's going and buying their own home, the first home buyer, and the first home buyer has a minimal deposit or contribution. The first thing the bank's going to sit there and say is, well, okay, well, how on earth are you then going to be able to manage the repayments moving forward? If you can demonstrate that you've got a track record of paying on time with certain lenders, rent over a period of time, consistent, well, hey, that's in lieu of the repayment that you're going to be making on a mortgage, same sort of thing. And I think with respect to that, getting past that contribution is an issue. You need to get a little bit more savvier. Even if you're an existing business owner or you're a startup, you need to turn around and say, hey, okay, I'm coming to the lender for funding because I don't have it all myself. You need to look at other ways. There's two ways to grow businesses, and you see that the larger businesses, and obviously publicly listed companies, they fund through. We're talking about debt here, but there's also other ways. You can fund through debt or you can fund through equity. And you need to get savvy enough to turn around and confident enough within your business idea, especially for startups, to turn around and say, hey, sometimes instead of using debt to fund, I'm going to use equity. I'm going to bring in equity partners, offer them 5, 10, 15, 20% to actually obtain some capital that I can contribute and put up towards to get the thing up and running. A really effective way of doing it. Now, a lot of small business owners, probably don't have the confidence to do so or know about how to offer up a percentage. So if I come to you, David, and say I'm going to give you 10% of my business and I want 100,000, the first thing as a potential investor in you is to go, okay, cool. Well, how do you work out that your business is worth $1 million? So you do have to get savvier. You do need to engage, be it a business coach, accountant, etc., to be able to value your business idea. Do that though. Don't always rely on debt.
Okay, so really, what I'm sensing out of this whole contribution discussion is that this whole financial intelligence, actually understanding more than just the cash in bank component of the business, is actually going to create a strength for someone to not only get money from the bank, but to actually get money from many different places.
You got to engender confidence. That's one way to do it.
Okay, fantastic. Let's move on to the next one, which is servicing.
So servicing, so if we go back to the first exit for a bank, servicing is the key aspect of proving to the bank that you can pay out the loan under the terms and conditions in which the contract is written. So it's equally as important for existing businesses, for startups. So existing businesses can be a lot simpler in that you have history, you have trading records, you have statements that you can prove servicing, you can demonstrate, you can use past history.
Okay.
I use an example of a recent client. Was a startup business, and to explain the difference in servicing and the preparation that you possibly need to do before you apply for the financing, to understand, going back to Mark's point, what does the bank want to see?
Right.
He ran a successful small business, and his wife, was a wage earner.
Right.
They were looking at moving back to her regional town for family and lifestyle reasons, and taking over the local pub.
Okay.
They came to us. They were in the process of applying for finance, and they were both ready to sell the existing business and quit the job and move back and invest in the pub and use that as their full-time job going forward.
Right.
Some preliminary assessment and inquiries with the lender we were looking at going through, and looking through the financials of the pub and the past history of the pub. Clearly illustrated that the financials of the pub and the projection of the pubs weren't going to be adequate to service in isolation. So we went back, spoke to the clients and looked at their options before we applied for the funding. One, to increase our chances of getting the approval, but more importantly, to avoid a decline, which will have issues going down the track, which we'll talk about a bit later on. So understanding and asking questions of the bank and of the lender of what revenue will you use and what revenue won't you use?
Right.
What expenses are you expecting us to account for, be it personal and for future business expenses? And how are you going to assess the rates? And, not what is the current rate, what are the assessment rates you're going to use that we have to take into account from a servicing point of view?
That's like knowing the formula before you put together the proposal.
Absolutely right.
Ask the question up front.
And you can't be expected as people that don't work in the industry, people that work in the industry, the formulas can be quite complex. But actually having a relationship manager who'll sit down with you and walk you through that is the first step. And you want a relationship manager who's invested in that relationship as much as you are to help you walk through and explain what those questions are, because that can have major impacts on how you, one, set up your business, the partners you join in, or more importantly, how you structure the business to actually meet those needs.
Yeah, because I suppose really for some people in business, getting this funding is a make or break thing.
Absolutely.
Without the funding, they can't grow the business. It's to invest in something that's a great idea or a great opportunity at that point in time. And I know your typical bank will say, well, put an application in for a loan, and 3 weeks later, we'll let you know if you've been successful.
Yeah.
Now, I've had this experience where I've gone to the bank. It was for something sort of different. We were going for a credit card processing
Merchant facility.
Yeah. And go figure, I went to the bank. They said, put your application in. And I put it in. This was like 6 months ago. And they said, you've been unsuccessful. I said, I've been in business 13 years. I've got a facility with another bank, and we're putting money through every single month. How could I don't understand what's the criteria. And the answer was, we can't tell you the criteria. You can reapply if you wish. And it was like, this is silly. And I just got frustrated. Luckily, I knew someone in the bank, and I said, what's going on? They said, I'll fix it for you. Now, that proved to me relationship.
Absolutely.
Right? Because within 24 hours of I'll fix it for you, I got approval. Nothing changed.
Yeah, we find issuing applications without understanding some basic lending criteria is a bit like Russian roulette for some of the banks.
Yeah.
Depends on who the assessor is at the end of the line.
Right.
And by sitting there having a discussion around what those criteria are before, as I said, can actually structure and change the way you set it up. So in this case, the outcome of that was that the male applicant decided to stay in his job, decided to continue to manage his business for the short term because they needed the revenue that was generating to support the application.
Yep.
That resulted in him putting in a part-time manager in the pub to manage the day-to-day operations of that, while his wife did move back and also worked in the business. So it enabled us to actually structure that a little bit differently for the short term to get the funding up and running so the pub could be successfully purchased and managed, and then they could reassess it down the track on how they wanted to manage that ongoing.
Awesome. Okay, so really just making sure you've got the right structure or the right representation to the bank.
Absolutely.
Because as Chris was saying there, the layperson would sit there and go, hey, okay, well, the reality is I've run a successful business. That's enough demonstration to get it up and running. But what they were doing by moving out of their existing business, taking away one of their biggest assets that the bank wanted to know. The banks want certainty. The certainty that these people had was the existing business's income. Stay within it. Fork out some money, basically, to have an in-house manager within that existing business and also in the pub. Hold on to the property as well, because they were going to sell their house. They go, okay, if we sell the house, we're going to have a larger capital contribution. That's going to be more valuable than, hey, no, hold on to the house, generate rental income out of it. They had a negligible debt, so they were actually going to be robbing Peter to pay Paul to start with, right? They had contributions sorted anyway, so they didn't need to sell the house to get contribution. What they needed to evidence was, as Chris was saying, servicing, bolstering up their income, because the pub, as you can imagine, the regional pub, they weren't keeping great records. So they needed every other stream of income they could, and so that was the difference in the positioning of the application Chris put together.
Yeah, fantastic. Okay, so very interesting. So let's move on to the fifth one, which is background.
Yeah, and a follow-on, I could actually use the example that Chris was talking about there in terms of that regional pub. What we had there was we had the male applicant, as we said, was running his own business. Now, that business was in a printing industry, totally unrelated to the business that they wanted to move into, which was the pub business. So what we had to identify there was say, okay, and I think you probably attest to this, David, successful people in business can overlay a lot of the principles that they have in one particular business and overlay it into another one. Not all the time, but in certain circumstances. Absolutely. So we had to identify what was he doing in his existing business that was important in the running of a pub. And we identified 3 different things. So we sat there and said, from a background, management and running of a business, most businesses don't necessarily fail. Again, your experience would be interesting in this in terms of because of the idea. Businesses fail because of the people.
Always.
All right, so
almost always.
So the reality is, it's okay. Well, that's why banks are so interested in management and so interested in who's actually running the show, because there's plenty of sound businesses out there that get run into the ground for a range of different reasons. So the background of this particular business owner, we had to identify the key things that would help make the pub successful. His wife was working in hospitality, so she had a link directly to the industry that they were moving into. But her focus was particularly on event management. Now, what this pub had was an unrealised asset They had a great physical asset. The actual pub itself was fantastic, but they had a whole range of rooms that were underutilized, be it event rooms and also accommodation rooms.
Yep.
So what the female applicant was bringing to the party was how do we start to maximise those particular parts of the building. But
Yep.
what was still missing from the bank's perspective was, okay, that's all well and good, but you know what? You're moving from a long way away, and our experience is running regional pubs as much as running metro pubs is how do you get people through the door?
Yep.
How do you continue to get people through the door?
Mm.
So what they had was the father-in-law of one of the applicants was a local, a very successful businessman as well too.
Yeah.
And what he did was he came to the party with respect to a contribution.
Mm-hmm.
He came in as a business partner, and
Right.
what he gave access to was the people walking through the door. His network of businesses that he had worked with
Yep.
was the link between getting them in the door and actually utilising these function centres.
Yep.
And once we brought that partner into the equation,
Yep.
the banks felt a hell of a lot more comfortable about what they would deem, I suppose, outsiders coming into a local area
Right.
and being able to drum up business.
Okay, so really making sure that there is a background sort of part of the document which gives the bank confidence that there's some track record there.
Huge part of it.
Fantastic. So let's move into the right or the major reasons for decline.
Yeah.
Because it's probably one of the worst letters people get, which is thank you for your application, but you've been rejected.
Yep.
Call this number if you want to discuss it, and
Yep.
really they don't want to discuss it.
No. Well, think about, I suppose, just on that, you could your feelings as soon as you receive for something like a merchant facility at the end of the day is taking income in, and you could, as you said, how did you feel after that?
Well, the bottom line is it's just a headache
Yep.
because I'm assuming that there's no problem and this should happen, and now all of a sudden I've got now a task. I've got to go and work out why, and you get stonewalled because as far as they're concerned, you didn't pass their secret application formula, which they can't tell you.
Yeah.
I felt like throwing the phone through the window, to be honest.
Yeah. And it's time that you don't need to invest in.
Exactly.
That.
So the last thing anyone wants to get is a decline letter.
Yeah.
So let's talk about those reasons.
Yeah, and it's an extension, I suppose, of those 5 points that we were talking about. What are
Yep.
the key ones out of those? And the first one is information and assumptions. What you'll find is, and in particular, a lack of information. So for people buying an established business,
Yep.
and even those that are starting up a new business, but information in particular,
Mm-hmm.
say I'm going to go and buy the corner milk bar store,
Yep.
the pizza store, and particularly a lot of retail shops. The reality is out in the environment there, cash is still king in a lot of those businesses, and
Absolutely.
that's great. But
Yep.
those particular businesses, at some point in time, have to have addressed their exit point.
Yep.
And if you're going to address your exit point and your exit point is a sale, then the biggest thing that you're doing that's hurting your ability to sell the business is not keep accurate and audited and correct financial details. So the number of people that turn around and go, hey, you know what? I can turn that corner store, that cafe, always busy. Hundreds of people in there. They must be making an absolute fortune.
Yeah.
And the reality is the business owner, for whatever reason, wants to exit. They're sick of serving coffees.
Yeah.
You come in, you go, I can even build on this particular business.
Yeah.
You get the financials and they're just not even close to representative of what the business is doing. It's making it tough. Right, so a lack of financial data on those businesses is the number one reason that we see that the clients get declined for, and an inability then, as an extension of that, when you talk about assumptions and planning, an inability to make accurate and reasonable assumptions about how they're actually going to improve an existing business or how they're going to generate the cash flow required in a new business to repay a loan. So. A lot of people make aggressive assumptions, and banks don't like aggressive assumptions. So you need to be conservative in every element. Chris was talking about serviceability, sensitized interest rates. They're going to take a sensitized rate. If you have to pay 7%, they're going to assess you on 9%. If you think you're going to generate, or the existing business is generating 50 grand, and you reckon you can turn around to 70 from the start, you're kidding yourself if you think those assumptions are going to help you get across the line. If anything, forgetting about whether your assumptions are correct or not, the business manager is going to turn around and say these guys have got their head in the clouds.
Right.
Assumptions are a killer. Making incorrect assumptions or aggressive assumptions.
So we're still getting back to this whole financial mastery or understanding the finances of the business.
Yep.
Not only from the point of view of money coming in, but also how to project where the costs are, where the income is, and do it in a reasonable way that the bank can say, yeah, look, that makes sense for this kind of business.
Out of your 20-page nice business plan that's in your office, that's in the top drawer, the bank's interested in 3 pages of that 20, and it all revolves, and we keep coming back to David. It's cash flow.
Yeah.
It's cash flow. How are you going to demonstrate consistent and strong and growing cash flow to meet your obligations?
Yeah, very interesting. Yeah, very interesting. So let's talk about the next reason, which is background. So that's come up a couple of times.
Yeah, so Mark touched on background in one aspect in terms of bringing somebody with a network and experience that you may not have to strengthen the application.
Yeah.
And that is one reason why they do decline. Applications get declined. Another major reason that's associated with background is what we'll call skeletons in the closet. So credit history checks.
Yeah.
If you've got a credit history issue and you know it exists, the best thing you can do from a bank's application perspective is be upfront, be honest, identify it, explain the reasoning, explain the action, explain the outcome.
Right.
Banks hate surprises.
Mm-hmm.
And if they find surprises, they'll come back asking more questions than it's worth.
And you're already on the back foot.
And you're already on the back foot. They start looking for more. If he hasn't told us that, what else hasn't he told us?
So are you suggesting it's worth doing your credit check on yourself?
Definitely.
Absolutely.
How do people do that?
You can actually just engage a professional to do that. They're quite easily to do. Or you can actually register through a number of credit.
Vita Advantage of the platform known as VEDA.
VEDA.
So you can request a credit check through them directly. As mortgage managers, we're required to do them on all of our funding for people that are looking for residential funding. So the cost of those are not significant, depending on the type of checks that you're doing, anywhere between $20 to $100. But definitely worth your while to be on the front foot, because as Chris said, as soon as you get a surprise, Chris was saying, they're going to ask more questions. More often than not, they won't ask any more questions. They'll stop it right there and then, and they'll say, "Hey, okay, surprise number one, thanks, but no thanks."
Yeah. Okay. So really, that's a critical aspect of the background.
Absolutely. Something that's also unknown to a lot of applicants is banks actually do what they call risk assessments against clients. And risk assessments are made up of a number of factors to do with the application. But there's a number of things that you can actually do to increase your risk rating within a bank.
Okay.
That is, and they're very simple things like full and complete details in application pages. So when you're filling that in, make sure you fill in all the details that increases your risk rating. They're looking for stability of employment, not necessarily just in your one job for 10 years, but in an industry, or having stability of employment, having long-term employment.
Right.
Even things like owning a home versus renting, married with kids, all those types of things increase your risk rating. One, because when you think about it from a bank's point of view, they want someone that's stable, they want someone that's settled, and they want somebody that's consistent.
Right.
So if you can think of those things and include those in the application, you'll be a hell of a lot better.
So oversupply of information is always going to work in your favour.
Absolutely.
Yeah. Right.
Absolutely.
Okay, so let's move to that last reason for decline, which is the bottom line, servicing.
Absolutely.
Why do I need a loan? Because I don't have money. How do you service? So.
And this goes back to it's a summary of the points we raised earlier in that ask questions of the bank in terms of how do they assess the revenue that you wanting to declare? How do they assess and what expectations they have on you around declaring expenses? And how they're going to assess the rate.
Right.
And also being prepared, understanding that is there work I need to do, or are there things I should not do before I apply for the finance? The case of the pub, for example, he did not sell the business because ultimately he needed the business. If he had have sold the business and they had have sold the house, they wouldn't have got the funding because you can't reverse those two actions. So don't act before you understand what you need to provide.
Right. So a bit of due diligence in the front end, just understanding what's the bank looking for, what can I control before I go to the bank. Can actually make sure that servicing's up to speed.
You hit the nail on the head at the start, David. So a lot of people tend to just go cap in hand, and it's okay. Well, what will you give me? You just have to reverse it. You have to go on there and saying, hey, okay, this is what I'm looking to do. This is what I want. Talk to me about how you can provide it. What experience have you got in providing it? Is it worth us taking that next step and putting an application together, and be prepared to do it with more than one organisation?
Yeah, but you're right. It's a mindset shift because most people will go to the bank and ask, as opposed to go to the bank and say, well, what can you do for me?
Well, you see it. How many business ideas do you reckon are out there in the ether, right, that either did start or didn't really get past their infancy because at the end of the day, a lack of funding to get going? And I'm betting a whole range of them were probably taken up by others that did it, or are just sitting still out there, not getting past go.
Yeah, and you're right. It's the confidence in the idea. It's the confidence in the plan. You go to the bank, they see confidence. They're trying to sell money, essentially. And they're looking for a good place to sell it to, and so if you can demonstrate that, they're in.
And also be very aware that a funding application decline sits on your credit report. you want to ensure you don't have declines in your credit report, because the next application will see that decline. They'll ask questions why.
Right.
And they're going to be unlikely to actually apply or provide funding to somebody who has been knocked back for another bank for other reasons.
Right.
Be very aware of that.
Excellent. Okay, good tip. Okay, so let's move into the next stage. So what's the right type of funding? So there's obviously lots and lots of different options.
Yeah. And the reality is there's predominantly secured and unsecured funding, and we've covered off this a little bit before, the types of security you can offer.
Yep.
And then obviously obtaining unsecured finance. Yes, it's possible to obtain unsecured finance. However, at the end of the day, if you were to break down those 5 sort of key secrets, if you don't have any one of those particular areas, geez, you need to have your ducks in a row in the other 3 or 4. If you start to have crosses against 2 of them, it's going to be really hard. And the reality is, for unsecured funding, you really need to have ticks against each one of those, other than security. So if you don't have security, all those other 3 that we were talking about,
so much more
critical. Hugely important. You want to talk about financial literacy, you need to be across the board. In terms of the actual types of loans, we're going to cover this off. Term loans, at the end of the day, is in line with, I suppose, what people are familiar with on their own residential mortgages. The term loans for business funding, 10 to 15 years.
Right.
They traditionally carry a little bit of a higher rate, but term loans are used for when you've got a large purchase, and then you've got certainty of repayment over a period of time.
Okay.
The next type of funding is overdrafts. People possibly are not familiar. They can be unsecured or they can be secured, either or. And overdrafts are, in principle, supposed to be temporary types of funding arrangements. Reality is, exactly right. And what you'll find is that, that said, if you're being approved for an overdraft, remember that the bank only makes money when you use it. So there's no harm in using an overdraft, but understand that they're going to review that overdraft and look at it a lot closely, because they don't want you to be sitting in overdraft for a long period of time. So if you've got an overdraft facility, the aim is to say, obviously, be drawing upon it and then paying it down on a regular, in a regular scenarios.
Right.
Aside from overdrafts, is commercial and bank bill funding. This is a little bit more, I suppose, what you would call professional way of funding, or those that are a little bit more financially literate. There's different components to bank bill funding. The way in which they set rates is different, and the way in which they review it is a lot quicker than term loans, on a more regular than term loans. And then you're talking about business credit cards. Business credit cards anywhere up to sort of $50,000 are available. Quite often this is how startups get going, because they don't have the necessary security. They can be a trap. I hate credit cards, but hey, sometimes they have to be utilised to be able to get yourself up and running.
They're quick and convenient, right?
Yeah, exactly right. And the last one is, we touched on before, invoice and debtor finance. That sort of area, as we said, is hugely growing. Understand that copying 80% of 100% invoice and foregoing 20%, to get money in the bank today, the value of money, it's worth more to you now than it is worth to you tomorrow. And if it allows you to fund growth and it allows you to keep, keep growing and write more sales, it's not necessarily a forever solution, but it might be one for people that at the end of the day have got terms at the end of the day that aren't favourable to them, and they have to offer unfavourable terms to get their business up and running.
Right. So sometimes, like, cash is king in business. Sometimes you have to sacrifice, and it's, I'm not a big advocate of discounting, but discounting to get money in early is cash flow. And if that cash flow allows us to invest in other aspects of the business, it will permit the growth. Yeah,
definitely. And 80% of something up front is possibly better than 100% or 90% in 4 months' time, because a lot of businesses don't get to that 3rd or 4th month.
Great point. Okay, the last one you had is equipment financing.
And again, that's the extension of what Chris was talking about before. Don't think at the end, when you talk about equipment financing, there's 2 components to it. It's financing to buy equipment, but also utilising equipment to get funding for other purposes as well too.
Yeah, fantastic. All right, lots of valuable information today. I suppose if we're going to sum up what we've talked about.
The reality is, I suppose, the thing that we would like to get across to the guys listening today is really change your psychology around how you approach business funding. Don't think that it's not possible out there. We're not here telling you that at the end of the day it's a walk in the park. The reality is there's a reason why business rates are higher than home loan rates, and there's a reason why banks lend a lot less to businesses than they do for other purposes. But if you change your psychology, ask the right questions up front, arm yourself with more knowledge, you're going to have a much better chance of success in securing the funding. Even if it's not the 100 grand you asked for, you might get the 80, and the 80 gets your business idea off the ground.
So really the psychology is key here. The preparation, the having no fear of the bank, and asking very clear questions about what can and can't be done and what are you expecting before you put a submission in, because it sounds to me like you put the wrong submission in.
Yeah.
And you actually end up going backwards further than you think. Not only do you get rejected, you now have a black mark against your name.
And you're right around the planning side of things. One of the biggest things we see, and we talk to our people that are looking to become self-employed, as soon as you become self-employed, funding becomes harder. So if you're a salaried employee at the moment, or your partner's a salaried employee, and you're thinking about starting a business, go and secure some funding while you've got whilst you've got an income source now.
Yeah.
Okay, a consistent income source.
Yeah.
It's a valid reason to secure funding. Go and do it now and get your planning and tuck the money away. Hey, if the business idea never gets up and running, doesn't matter. You've got the credit there available for a rainy day.
Yeah, fantastic. So, look, I suppose if anyone on the call is interested in further info, what's the best way to get in contact with you guys?
Yeah, they can jump on they can give us a buzz on 1300 780 440.
Yeah.
For people that are listening today, we've got specialised business guys that work for us. But for those that are listening today, they can get access and have a chat with Chris or myself. So just call that number. You can jump onto our website, www.financepath.com.au.
Yeah.
We'd love to have a chat with them, and if it's not us, that we don't believe that we're the right solution for them, maybe we can steer them in the right direction and give them some better questions to ask of existing relationships they have.
Because it's really, it's like, if I was to summarise what I've heard today, it's about knowledge, right?
Yeah.
It's knowing how to approach things. It's knowing what questions to ask. It's having the financial knowledge of the business. Now, all of these things I would recommend as a coach anyway.
Yep.
I think, when we talk to business owners, we talk about that mastery level and say, look, you need to know your numbers. And people glaze over. And really what you've just told me is we can go to the bank and ask for money based on knowing our numbers, not based on the business results, but based on knowing our numbers. So the knowledge of those numbers is what's going to move us forward in the business.
Yeah, correct.
So an interview in a bank should be no different than interviewing any other business relationship, referral partner, or strategic alliance you have. It should be seen as a relationship.
Yeah.
It should be seen as got to be a win-win. It should be seen if they're right for you, equally if you're right for them. So change your mindset and you'll get a better result.
Yeah, fantastic. Look, guys, I just wanted to thank you very much for your time today. It's been awesome. There's some great tips in there. I'm sure if anyone's got any questions, they can either jump on the website or they can reply to the email that will go out after today's presentation. So I just wanted to thank you both for your time today.
No problem.
Thanks, David.
All right, thanks, guys, for listening. Look forward to catching you at the next one.